Welcome back to today's Explainer. All right, we are diving into the absolute undisputed king of AI today, Nvidia. The financial media, they just eat up the revenue beats, right? And retail investors absolutely love the earnings surprises. But honestly, we're ignoring all of that hype today. Instead, I'm putting my equity research analyst hat on. We are going to conduct a full forensic audit, digging deep into the numbers and those tiny footnotes that the headlines always ignore, just to uncover the real reality behind this massive valuation. Just try to wrap your head around the sheer scale of this number. A $5.4 trillion market cap. I mean, the stock is up over 100% year over year in this last cycle alone. That's staggering. But look, we really need to pump the brakes here and ask a pretty uncomfortable question. Is this the greatest business of our generation? Or are we buying into a house of cards at an absolute premium? Before we answer that, let's get the legal formalities out of the way. So, real quick disclaimer, this explainer is an educational case study on a quantitative analysis meant for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance obviously does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. Oh, and all data is sourced from publicly available filings. Got it? Good. Okay, let's dive into this. Here's our roadmap for today. We'll start with the valuation gauntlet, uncover the red flags, pivot to the green flags, look through the legends view, and finally deliver the verdict. All right, part one, the valuation gauntlet. So starting out at a current share price of around $225, we actually ran 21 different financial models just to see exactly what the underlying math is telling us. It's kind of like a giant puzzle. Group A, the standard cash flow models assuming a blistering 20 to 25% growth, put the value at roughly $195 to $230. So pretty much aligning with exactly where the price is right now. Group B, the dividend models? Yeah, just toss those out completely. It pays a $1 dividend on a $225 stock. This is definitely not a dividend story. Group C's comparables put us at $180 to $250. But here is the kicker. Group E, real options. This is the ultimate wild card. Using Black-Scholes logic to value future speculative optionality, things like robotics and sovereign AI, we get a massive $350 to $500 future valuation. That is literally pricing in the ultimate dream scenario. So what happens when we average all these models together? Well, the blended verdict comes out to a range of $220 to $280. The pure math essentially tells us the stock is fairly valued, maybe modestly overvalued. But hey, math doesn't tell the whole story, does it? To get the absolute truth, we need to look much deeper into the footnotes. Which brings us to part two, uncovering red flags. Look, the analysts on TV, they only care about revenue beats, but we are going to dig way past the media headlines to expose the hidden red flags, the buried bodies, hidden deep inside the SEC filings. Get this, $95.2 billion. This isn't just sitting inventory. These are outstanding purchase commitments. That is literally triple last year's amount. To put that into perspective, if AI demand slows down even slightly, this poses a massive write-down risk. The media completely ignores this because, let's face it, supply chain semantics just don't fit into a neat little soundbite. And then we have what I like to call the cash flow trap. Check this out. Net income is sitting at a highly profitable $159 billion, but levered free cash flow, that's just $46 billion. That is a shockingly low 29% conversion rate. Why the huge gap? Because all that cash is tied up in inventory. Cash flow is boring to talk about, right? EPS beats are exciting, so this massive discrepancy goes almost completely unreported. Let's quickly but thoroughly run through the rest of these hidden flags that really skew those glowing media headlines. First, they quietly took a $4.5 billion charge for excess H2O chips. That's a $1 billion inventory flush buried all the way back on page 47 of the 10Q. On top of that, their GAAP net income includes $13.4 billion in unrealized paper gains, so not actual operating profit. Then there's the $14.4 billion in goodwill they booked from buying Grok, which is a massive impairment risk if that integration fails. Oh, and inventory turnover actually dropped from 4.25x to 3.97x, meaning chips are sitting on shelves longer. And finally, rising days sales outstanding, or DSO. Customers are taking longer to pay, which is historically a classic sign of channel stuffing. But let's be fair here. Part 3, the green flags. It's time to pivot neutrally and acknowledge exactly what the bulls are getting absolutely right about this company. Deferred revenue is growing significantly faster than their sales. Why does that matter? Well, what you should take away from this is that it proves they have a continuously expanding moat. Customers are literally handing over cash up front for future software and services. That is incredible pricing power. And the bulls definitely have plenty of other green flags to point to. Back in May, they authorized an $80 billion stock buyback. Guys, that is pure, undeniable confidence from management. They also possess a massive tax net operating loss shield protecting their future cash flows. And while it's true some C-suite executives are taking profits, independent directors are actually actively buying the stock. Plus, and this one is just absolutely mind-blowing to me, their capital expenditure is under 3% of revenue. For a company that builds hardware, that kind of CapEx efficiency is completely unheard of. Throw in gross margins recovering to the mid-70s and a decreasing dependency on U.S. revenue, which spreads out their geopolitical risk, and honestly, the bullish case is incredibly strong. All right, part 4, the Legends View. So if we completely step away from our modern spreadsheets for a second, how would the all-time investing legends interpret these exact same numbers? Let's start with the father of value investing himself, Ben Graham. If we calculate the famous Graham number, which factors in earnings and book value, it yields a price of just $34 a share. Compare that to the current price of $225. It's not even close. The company completely fails his net current asset value metric. Because of that massive, glaring gap, Graham wouldn't just walk away from this valuation. He would run. His theoretical verdict is an absolute, definitive hard pass. But what about a legendary growth investor like Peter Lynch? Now, Lynch loves using the PEG ratio. With a PE of 34 and a blistering growth rate of roughly 55%, the PEG ratio sits right at 0.62. And since any PEG under 1.0 is generally considered a buy threshold in Lynch's playbook, he would look at this situation completely differently. Lynch would probably just ignore the book value entirely. His theoretical verdict would be a strong buy, considering the stock remarkably cheap relative to its insane growth rate. Finally, let's bring in the ultimate quality compounder, Warren Buffett. Buffett would balance his absolute love for a fortress balance sheet, we're talking a return on invested capital over 100% and negative $53 billion in net debt, against the cold, hard reality of the price tag. Now, the economic mode is incredibly wide, which is right up his alley, but paying 34 times earnings, that is a historically high multiple for him to swallow. So Buffett's theoretical verdict lands perfectly in the middle. He would undoubtedly recognize this as a phenomenal, world-class business, but he'd demand a much larger margin of safety before buying in. It's the classic Buffett mentality. Great business, bad price. I'll wait for 160. Which leads us to part 5, the verdict. Bringing all of these threads together, we've run the math, we've dragged the red and green flags out into the light, and we've consulted the legends. So what does this all mean? The crucial point is this. They undeniably possess one of the widest, most defensible business moats in the entire world right now. Between their intangible CUDA software ecosystem, the immense switching costs for their clients, and the powerful network effects of developers constantly improving the platform, the business itself is an absolute fortress. But, and it's a big but, that leads us to a classic conundrum. You are buying the best business in the world at a price that leaves absolutely zero margin for error. Perfection is already priced in. When you factor in that $95 billion supply chain risk and the inventory bulls we uncovered earlier, you realize that a single bad quarter for the AI narrative could easily trigger a 30 to 40% correction. That would drop the stock right back down to that $160 range. The models point one way, but those hidden flags suggest a storm could be brewing. So I'm going to leave you with this question to consider, and I'd actually love to hear your thoughts on this down in the comments to help out the channel. Is it worth paying full price for perfection right now? Or are you better off waiting for the inevitable correction? Look, I don't have a crystal ball, but now you have the numbers. You have to weigh the flawless business against the flawless price tag. Do your own homework and decide which side of the trade you are on. Stay skeptical, keep learning, and I'll see you in the next explainer.